Everyone is talking about what's going to happen to the American economy, the tariffs, the Fed, the S&P 500, inflation, the recession that may or may not be coming. And that's exactly why most will get it wrong now. Not for lack of information, for lack of direction. Because you watch video after video, you read article after article, and in the end, you know more about the problem and exactly what to do about it. That changes now. In the next few minutes, I'm going to give you a framework with 3 clear steps for you to get out of here knowing exactly how to position yourself in the next 30 to 90 days. No prediction, no theory, direction. But before that, I need you to understand why you are stuck. Subscribe to the channel now. This is the kind of content you'll want to have seen before most. Let me describe a scene. You're following the scenario. The market has fluctuated strongly. The Federal Reserve has changed its tune. Some analysts say it's time to buy. Others say to wait. One talks about soft landing. Another talks about crash. And you stayed there, standing still, with the money in the account, unable to press any buttons. This has a name, paralysis by analysis. And it doesn't happen because you're uninformed. It happens because you're getting too much information and too little strategy. That's the real problem. Not the Fed, not the tariffs, not the volatility. The gap between knowing and acting. And it is exactly in this gap that most people miss the rare windows that the market opens from time to time. Think with me. Do you know how many people followed the 2008 crisis in real time and did nothing? The majority. Not because they didn't know something big was happening. They knew. But they were waiting for certainty, waiting for the perfect moment, waiting for it to be obvious. And while they waited, the S&P 500 rose more than 400% over the next 10 years. Those who built wealth in this period were not necessarily the ones who knew the most. He was the one who had the structure to act when most were paralyzed. Now look at the current scenario. High volatility, political uncertainty, Federal Reserve navigating tricky territory, market testing everyone's nerves. This kind of scenario, where fear and opportunity coexist, is exactly the environment where real estate is built or destroyed. What you do in the next 30 to 90 days can directly impact your assets for the next 5 years. I'm not saying this to create anxiety. I'm saying to create urgency with direction. They are completely different things. But before the framework, you need to understand one thing. The problem is not the economic scenario. The scenario has always been uncertain. It always will be. In 2001, it was the bursting of the technology bubble. In 2008, it was the collapse of the financial system. In 2020, it was a pandemic that no one predicted. In each of these moments, there were experts on both sides. Buy now, wait, run away, stay. The problem is that when you consume a lot of information without a strategic filter, each new headline changes its direction. You capsize a rudderless boat in rough seas. The solution is not to consume less information. It is having a structure that transforms information into decision. This structure has 3 stages: protection, positioning, execution. When the market enters phases like this, these 3 steps need to be followed in that order. Skipping any of them is the mistake that turns opportunity into loss. I'll explain each one to you now. The first step is protection. And I know that's not what you want to hear when everyone else is talking about opportunity. But that's exactly why I need to talk about it first. Moments like this have 2 faces. One face is opportunity. The other side is the amplified risk. Those who ignore the second cheek end this cycle worse than they began. That is the mistake. Let me give you a quick number. After bottoming out in the 2008 crisis, the S&P 500 rose more than 400% over the next 10 years. But most of the individual investors who entered in that period came out at a loss. Why? They entered without protection. They needed the money ahead of time. They sold at the worst time. And they turned the largest recovery window in modern history into a real loss. Protection is not pessimism. It's what ensures that you'll stay in the game long enough for the opportunity to work. Without protection, you are not investing, you're betting. So before any decision, you need to answer 3 questions. First question, do you have an emergency reserve? Emergency reserve is not an investment. It is basic protection. It's money that ensures you'll never need to sell an asset at the worst possible time. The ideal size is between 3 and 6 months of your monthly expenses in something liquid and affordable. High-yield savings account, money market fund, short-term treasury bills. Anything you can access quickly without penalty. If you don't have that yet, that's your number 1 priority. Before any other movement. Because without reserve, any rare market window becomes a trap. You come in, the market falls more in the short term, which is absolutely normal in any cycle. You need money, you sell at a loss, and you end up blaming the market for a decision that was one of structure, not analysis. Second question, do you have expensive debts? Expensive debt is anything with high interest rates. Credit card debt, personal loans with high rate, anything above 15–18% per year. Here's the problem. If you have expensive debt, no investment will earn from it consistently. None. Paying off expensive debt is the investment with the best guaranteed return there is. There is no asset in the American market that delivers 20% per year with consistency and security. So if you have expensive debt, your money goes there first. Without exception. This does not mean being left out of the cycle. It means entering with the ground clear, and then every dollar invested works for you, not against you. Third question, can the money you are going to use stay put? This is the most common mistake in moments of euphoria. People put money that has a defined destination, down payment, education, family emergency, in risky assets with an uncertain horizon. And when the market fluctuates, they need to redeem ahead of time, and they rescue at a loss. The money that will work at times like this needs to have a real horizon of at least 2 to 3 years. You need to be able to look at this money and say honestly, if this is stopped for 3 years, it doesn't compromise my life. If you can't say that, adjust the position size, enter with less, but enter with the right size. These 3 questions seem simple, and they are. But most people who lose money in big cycles don't lose because they chose the wrong asset. It loses because it entered without answering these 3 questions. They had the right direction, but the wrong terrain. Protection is what separates those who use the cycle in their favor from those who are used by the cycle. This is where it all begins. If this content is making sense to you, leave the like now. This helps this content reach more people who need to hear it. Now that you have the base, comes the step that most skip straight through. And this is exactly where the biggest strategic mistake lies. Step 2. Positioning. Positioning is where most people go wrong, not because they make the wrong decision, but because they make the right decision in the wrong order. They skip protection, go straight to positioning, and when the market oscillates, they panic and undo everything. This is the cycle, and that's exactly what we're going to break down now. Positioning is not choosing the right action. Positioning is defining where you are now and where you want to be in 3–5 years. This starts with a simple question. What is your horizon? If you have less than 2 years of horizon, that's not money for the stock market right now. With the current volatility, 2 years is not enough time to absorb fluctuations without compromising the result. Put that money into something that pays well and is safe. High-yield savings, short-term treasuries, money market funds. The Fed has raised interest rates aggressively in recent years. This created a real opportunity in American fixed income that has been asleep for more than a decade. You can find returns of 4.5% per year on very low-risk assets now. It's not the way to get rich, but it's the way not to lose while you position yourself. If you have a horizon of 3 to 5 years or more, then the stock market enters the conversation. And here I need to tell you something that goes against what most opportunity content says. You don't have to get the perfect timing right. You need to be in the market. Here's the number that changes everything. A study by J.P. Morgan analyzed the performance of the S&P 500 between 2003 and 2022. If you stayed invested for the entire period, your annual return was approximately 9.8% per year. If you missed only the top 10 days in the market in that period, 10 days in 20 years, your return fell to less than 5.6% per year. 10 days. In 20 years. And do you know when most of these days happen? Right after the worst. In other words, those who panic are exactly the ones who lose their recovery. The correct placement is not trying to guess the bottom. It is entering gradually, consistently, and with a long horizon. In practice, this means the following. If you are not yet invested, start now with a small position. Don't wait for the perfect moment. The perfect moment does not exist. Start with what you have available within your protection framework, and from there, apply dollar-cost averaging, fixed amount every month, regardless of where the market is. When it falls, you buy cheaper. When it rises, its existing positions appreciate in value. Over time, this strategy eliminates the risk of timing and creates consistency. Warren Buffett has publicly recommended this approach to most individual investors. It's not glamorous. It doesn't generate headlines, but it works. Within the stock market, the principle is simple. At times like this, with high macroeconomic uncertainty, broad diversification beats concentrated bets. ETFs that replicate the S&P 500 or the U.S. total market are the most solid starting point for most people. You don't have to guess which company will win. You're betting that the U.S. economy as a whole will continue to grow in the long run. Historically, this is a bet that has worked. But here's the layer that most ignore. Positioning is not just about where to put money. It's about how you're going to behave when the market crashes. And it will fall. Sometime in the next few months or years, you'll open the app and see red. The question is not whether this will happen. The question is, will you be prepared to do nothing? Because the most important decision in times of decline is not what to buy, it's what not to sell. Those who understand this before entering have a huge advantage over those who learn at the time of the fall. This is where everything changes. You have protection. You have positioning. Now comes the final step, the one that transforms all this into real results. Execution. Execution is where everything becomes real. It is the simplest step of the three, and at the same time, the most difficult. Not because it is technically complicated, but because it requires you to act at a time when everything around you is screaming to wait, and waiting seems like the smartest decision. But most of the time, waiting is the most expensive decision. Let me show you what execution means in practice. It's not opening an account and looking at the market every day. It's not buying a stock because someone on Twitter said it's going to skyrocket. It's not trying to catch the exact bottom of the market. Execution is simple. It's a set of small decisions made now that build momentum over time. This momentum is what separates those who build equity from those who keep saying that they would have invested. Here is the concrete plan for the next 30 to 90 days. Step 1. Answer the 3 protection questions. Emergency reserve, expensive debts, real horizon of available money. If any of these are not resolved, solve it first. Don't skip this step. This is the foundation. Without it, everything that comes after will crack. Step 2. Set a number. Not a vague goal like, I want to invest more. A real number. How much will you put on the market every month from now on? It could be $100. It could be $500. It could be $2,000. Value matters less than consistency. Set the number. Automate the application. Don't mess around. Step 3. Choose the vehicle. For most people, a broad market ETF like VOO or VTI is the most solid starting point. Low cost, high diversification. No need for constant monitoring. You don't need a complex portfolio to get results. You need a portfolio that you'll be able to hold on to when the market drops 20%. Step 4. Set your rules before you need them. Before you jump in, write down the answers to these questions for yourself. If the market falls by 15%, what will you do? If it drops 30%, what are you going to do? If some famous expert says that crash is coming, what are you going to do? Having the answers before the fall happens is what prevents emotional decisions at the wrong time. Because at the moment of the fall, you will not think clearly. Nobody thinks. The advantage of those who survive difficult cycles is not greater intelligence. It is having decided in advance what you are not going to do. Now, I need to tell you something important. Everything I've said here works regardless of what the market will do in the coming months. If the market rises, you'll be positioned to capture the rally. If the market falls further, you will be protected to buy cheaper without panicking. That's the power of having structure. You stop relying on foresight, and it starts to depend on the process. Process beats long-term forecast. Always. And the most dangerous thing of all? The most dangerous thing is not to make a mistake. It is not even realizing that there was a decision to be made. A few years from now, this moment will seem obvious. It will seem obvious that there was volatility creating opportunity. It will seem obvious that the fundamentals were there. It will seem obvious that it was time to act. But now it doesn't seem obvious. Now it seems risky. Now it seems that it might be better to wait. And that's exactly why most will get it wrong. Again, real opportunities never seem obvious at first. In March 2009, at the bottom of the financial crisis, the headlines spoke of the collapse of the system, the end of capitalism, in lost decades. Whoever bought it at that time seemed crazy. 5 years later, he seemed like a genius. The difference was not luck. It was structure. It was process. It was the ability to act when everything screamed to wait. This type of scenario we are living in now is exactly the environment where the foundations of real heritage are built, not in euphoria, in clarity in the midst of chaos. The difference between those who will look back 5 years from now with satisfaction and those who will look back with regret is not that they have chosen the right asset. It is in having acted before the majority, before it was obvious, before everyone was talking about how much they earned. You have the structure now. Protection, positioning, execution. The next step is yours. If this video brought clarity to you, leave the like now and tell me in the comments, which of the 3 steps do you need to solve first? Protection, positioning, or execution? Right down here, I want to read each answer. And if you want to keep building that foundation, the next video is popping up on the screen right now. Go there.